Good afternoon, everyone. I'm Sherwood Robbins, and I just thank you for the invitation, the opportunity to come and talk with you today. I'd like to go in a relaxed manner, so if there's questions kind of as we move through here, and I thought we use kind of whatever you want to use here is horses in the stable, tools in the toolbox, arrows in the quiver. These are loan programs that are out there. This is a focus on more of the federal side, whereas I know Frank and Brian are going to be talking about the state side. So it's kind of a nice, they all fit together, which is, this is just opportunities that are out there. And whether you know someone or you're a potential borrower and this becomes a tool for you, that's kind of how we take this approach. Is a lot of these programs for the right borrower, for the right use, it's a great use for the programs. A lot of times we suffer from an awareness. So these opportunities to come out and speak and just kind of give a brief overview and high levels. You don't need to read the 300-page manuals that I'm responsible for, but if you have an idea of what these loan programs do, so just diving right in, and definitely not going to make this too much of a commercial about my organization, but Seedco PA is, we're a 32-year-old organization formed back in the 80s. As a result of the changes to the IDA, the Industrial Development Authority changes tax code back in the 80s. The SBA came out with a newer loan program, then called the 503. We'll talk about that today, just part of the codes that it got released as of. So we're a 32-year-old organization. We do really focus on the SBA loan programs, but we want to be known as a federal, state, and local sometimes loan program expert. So we've got only an 8-person staff, so I myself am kind of a small business owner or small business manager. So we're working on those entrepreneurial ideas. But between us, I'm proud to say that between the 8 of us, we've got 70 years of combined SBA government lending experience. So we try to be the experts, don't know the answer to everything, but really try to have an understanding of what either the federal agency or the state or any local municipalities might be looking for. I would say this is a global topic, and I think Frank and Brian would agree on this, is just from a communication expectation. When you're talking to the lending organization, whether it be a bank, a credit union, one of us as an economic development agency, but it's all about communication and setting expectations. So I just kind of always put this out here as a great slide to say, are you talking to the right people? Who else needs to be involved? Is there a township approval, a clearance, a zoning issue? Is there an appraisal or an environmental that we have to really make sure is cleared up? Are all the people addressed and the language included? So we know we don't want to get to a close. I don't like the 11th hour in any way, shape, or form. We want to get to the 11th hour and be very comfortable where we are. So this is just a slide I put out here is how do we make it efficient, avoid delays and duplications, talk to people, get the right people involved, and as we approach the closing date, we're kind of in cruise control mode. Doesn't always work that way, but this is the game plan, is to set that. So just on to the loan programs themselves, and I would say this is on the federal side, this is a good rule of thumb. There's exceptions, and I kind of did this with parentheses behind the global topic. So for the most part, we're talking about for-profit businesses. There's different programs, there's different loopholes, or not loopholes, maybe the window's cracked a little bit ajar that we can work with a nonprofit. But for the most part, for-profit businesses to utilize these loan programs. Nonprofit might be a specialty circumstance like a municipal building. If they're building a new fire station, there are some federal programs that can actually go out to the nonprofit world and work with those. For the most part, again, owner-occupied property, not really for investment property. For owner-occupied business-owned property, there can be a real estate holding company to complement the operating company, perfectly acceptable. But for the owner-occupied is the right way to do this. No need to remember the numbers, but it's good to put them up here. Is what we're talking about really is measuring by square footage. Internal square footage greater than 51% occupied by the operating company. So it can be subleased, but there's rules and requirements in there. Some flexibility, some quirks as well. But for the most part, investment, there's a small handful that can get out there and say that we can do this project, but we're going to look to the end user. So is the end user a manufacturer, a center, a regional center, or something like that? So the developer, we might be able to talk about investment properties, but it's actually the end user that we're going to look to actually have that economic development, create a job, or stir growth. The part that's kind of new actually is discuss outdoor occupancy. So I remember about 7 years ago, I've been with the organization about 8 years, and we were actually talking a little bit, my background, I'm from Schuylkill County originally, which is very good, and I worked out through the Higgins Valley View and Pittman communities through, if you recall, Meridian Bank way back when. So that's kind of my throwback is I'm a recovering banker, and here I stand. But it really is that idea. I remember going back about about 7-8 years ago when I was first starting with Seedco PA, we couldn't look. We were working with an electrical manufacturer, or electrical contractor, I should say. And if you think about an electrical contractor with a fleet of vehicles, what's a very important part to that business? Parking area for the vehicles. So we were kind of looking at the square footage. The second adjoining property was just a gravel parking lot that they absolutely needed for the business. 7-8 years ago, that was kind of a concern about this outdoor occupancy. So they've looked at that today and say, wait, that's just as important as the internal square footage of the building to my business. And we can now kind of take a look at that. Machinery equipment globally, we're just talking long term, so not necessarily computers, although there's a way to finance those. But when we say machinery and equipment, we're talking about a useful life of 10+ years. Interesting one, we can talk about that, is some flexibility in there as well. Think about a Heidelberg press. Heidelberg press, large, long-term piece of equipment. We could actually take that, what seems to be machinery and equipment, and that's one of the things where we've actually financed that over a 20-year period because of the useful life of the equipment. So some flexibility in how we can use things. Most industries and projects are available. I use solar a lot of times right now. Solar projects unquestionably check the box eligible. Do they always work out? Sometimes not. If I put $1 million in solar panels on the roof, does that improve my property by $1 million so that I get the appraisal value? The answer is probably not. So from an underwriting standpoint, does the project make sense? So I kind of talk a lot of times anymore about eligibility, but will it underwrite? We blend the two together and have that upfront communication and talk about that. So most industries are eligible. We want to talk about the underwriting and does the project, not to make it too simplistic, but does it make sense? Can we make sense of this request? Sound underwriting, again, I don't think this is anything crazy. Perhaps we as a society and as a country forgot and kind of lost our mind a little bit prior to something that I call 2008. And we were maybe not doing some sound underwriting and doing some really aggressive lending out there, but this is always a good practice, is let's go to sound underwriting after you buy a building or buy equipment for expansion. Do you have enough working capital? So I got this great new building, but I don't have enough money to run the business because I put it all in the building. That might not be the best loan request, so let's talk about that. So I think they're good ways. Sound business summary and projections, and this is one where I always say, I never go, I don't scale in the office, and if I get a business plan in and it weighs 40 pounds, it doesn't make it a good business plan. So if I get a business plan that's 10 pages and it makes a lot of sense, and you can read it and say, well, that makes perfect sense, then that's the proper business plan, business summary. And then the last one is just, it never makes, any of these programs do not make bad loans good loans. This is the SBA 7A, so Small Business Administration, and if I end up doing any acronyms, because I live in acronym soup world, if I throw out an acronym out there that doesn't make sense, just kind of raise a hand and it'll trigger myself. But SBA is a Small Business Administration, federal agency. The 7A loan program is a deficiency guarantee program. So it lets the financial institution, bank or credit union, maybe make a loan that they otherwise conventionally wouldn't approve. So 7A is basically, this can be used for starting businesses. This could be used for expansion businesses where they have historic tax returns, but this expansion, the purchase of new equipment, is taking them to the next level and adding new lines of revenue. That would be a great use of the 7A. Some other benefits might be extended terms. So instead of maybe 3 to 5 years for a working capital request, it can go 7 to 10 years. Instead of 7 to 10 years on equipment, it might be able to go 10 to 15. So when I talk about with any of these loan programs, and any loan program, if there's not a benefit to you as the borrower or the business owner, no sense in using it. If I'm going to talk to you about a high fee and a bad rate and this and a that, you're going to show me the door pretty quickly. So we want to talk about benefits and how these work. Some of these will work for you, some won't. So it's really about, I use the S in Small Business Administration anymore, as the word small. But if we're doing projects up to $5 million, and as we'll see in a second on the real estate projects, up to $12 and $13 million, not such a small project anymore, but still through the SBA. So maximum loan size of $5 million. On the bank side, this is offered through a bank. This is going to be, they're really challenged to lend in their traditional style. How are you lending to small businesses today? Don't do anything outside the realm of that, but because of the guarantee, and the guarantee is basically this. You go to a federal agency on the front end before the loan is closed and say, if this business ever fails, can I come back to you, federal agency, and get a portion between 75 and 85% of my money back? So it gives them that confidence to actually make this loan that they would otherwise or might have already declined. 7A use of proceeds. The thing to remember about this is it's 1 wide open. How can we spend this loan proceeds? What can we use this on? So it can go all the way from, if you will, the most tangible, most fixed piece is a purchase of commercial property that we already talked about. It can also make leasehold improvements. So I don't need to own the property. I can come into any leased location, such as a restaurant, if you think about it, come in and make leasehold improvements, use these funds, and I'll pick out a few for the average restaurant request that's leasing, not owning. They want to make leasehold improvements, machinery, let's not say machinery, but equipment. They might be purchasing a stove, putting that in there. They might be working capital, and they need some inventory and supplies. So we can kind of take any industry that we talk about. What's a manufacturing need? A light manufacturer, you come in and they're actually buying the building, making leasehold improvements, or actually improvements to the property. They're buying some machinery and equipment. They're debt restructuring some of their capital leases that they have in place on some of the equipment on the floor. Let's take that all up, and we're going to go to the next slide and show in this 7A how I can take all these use of proceeds. If I have a 25 or 20-year building, and if I have 10-year equipment, and if I have 7-year working capital, one of the benefits of the 7A program is combining everything together in the simplicity of one loan, and we'll show you what a weighted average term looks like in a second. Those are the key to remember in the 7A is it really can get into the less tangible, the less actually equipment and real estate needs, and it can get into working capital, debt refinance, inventory, supply purchases. So project examples, things that I think these are the things that make this relevant, is a lot of times you'll see the 7A program because of that guarantee in challenging industries. Well, what are challenging industries? And we kind of know these already. Restaurant, just by category, a higher risk loan that a bank or credit union might make. Challenging industry might be hotel. The bank has just made a claim to their credit policy that they're not working with hotels right now. Go to the other side of the equation, existing historical manufacturer, professional practice, and we're kind of talking about the different industry sides out there. So challenging industry request is a good example. Leasehold improvements, that restaurant was a great example of what we've used this for. Change of ownership, this could actually finance goodwill. So business is selling, and you see a lot of this because of the unknown of this new management team that's coming in, but we're going to have a change of ownership, complete sale of the business. Included in that might be just this multitude of uses where you're buying the assets. Maybe it's not a stock purchase. We're going to do an asset purchase, but we're going to get the name through this. You're going to buy the assets. You're going to need working capital on the back end. You're going to need a new piece of equipment, and this is all together financing, and that can do that total change of ownership with multiple uses in there. Business expansion, and I think this is a manufacturer, and I hope we're going here soon. As the economy expands, this is the one where I might have a new opportunity that I can buy a new piece of equipment. That new piece of equipment can generate either greater revenues to the core of what I do today, or a new direction that's actually going to complement what I'm doing today. So I look at this and say, I think we're coming here. I'm glad we're going to do it. I don't want interest rates to jump too fast, too far, but as the economy grows, these are the ones I know we've seen in the past. They've been limited since 2008, but I think we'll see in the future, is that expansion concept. Refinance, restructure with extended terms, and I think the best way to show that is really this. A little bit of a busy slide, but I'll kind of work through it. I think not too far away. I think you can see all this, which is good. Traditional bank financing. I'm standing today on an existing business. I've got 3 loans today. It's a real estate loan for a 20-year amortization. Machinery and equipment, shorter term, but it was 5 years. And I've got working capital for 3 years. Each of them have their own associated payment, and my monthly total payment is $7,300. The SBA can take that structure and add. So if there's further money needed to that $500,000, it can also this. But for the sake of this presentation, I don't want to put this together. The concept of blending in the SBA world is this. That real estate would be associated for 25 years. The equipment would be 10 years, and the working capital would be 7 years. All in together in one loan. An average term between these 3 of 18 years, and the payment drops to $4,000 per month. So for me, if I'm talking to a potential borrower or prospect, and I'm hearing really often, my problem is monthly cash flow, monthly cash flow, monthly cash flow. Well, I know I can have a potential benefit using this program if I can go from $7,300 to $4,000 per month to a small business where that $3,000 makes a difference, makes a significant difference. So this is the kind of opportunity where I look at 7A and say, well, that's the benefit to that. One just quick case study, and definitely this was made for the handout, not for us to sit and read right now, me to read to you. But general concept here is an existing manufacturer. They have a building mortgage, they have equipment, term loans and leases, older repair and in need of repair or upgrade. They have a decision making. Which one am I going to do here? Am I going to repair what's existing and keep it on the floor? They were able to expand into a new product line. That was their opportunity. They would go and represent, projection base, about a third of the revenues in the future. Great opportunity. A little bit of risk because it's a third of the business. I'm talking about some concentration in there of one revenue line, but it's a projection-based expansion. This was to refinance and restructure the whole thing in addition to purchasing new equipment and actually going out to a little bit more working capital. 16-year loan, prime plus 275. I don't mix words about this. Oftentimes, the SBA 7A is a variable rate loan. So remember when I told you about this federal process, higher fee, I don't know if it's outrageous, but higher fee, variable rate. If I led with that, get out. If we talk about the opportunity and how to build this all together, and it's a true benefit, this becomes a good loan. What we basically have is a really short prepayment penalty on the 7A, only 3 years. So the prepayment penalty is gone in 3 years. If you're expanding, remember what the conventional banker is looking for, which is 2 to 3 years of historic performance on the tax return or the financial statement. So if they get that, then that's what happened here. They refinanced this with a conventional loan 4 years in. They were out of the prepayment penalty period. They're in conventional financing today. So the restructure got them there. Just jumping over to the 504, and I don't want to glance if I want to apologize here. I want to make sure of it. 504 is a little bit different animal, also through the SBA, but now we're going to kind of put blinders on. The blinders are fixed assets only. This is either a 20-year loan or a 10-year loan, commercial owner-occupied property or machinery and equipment. This loan is a little bit different structure. It's a partnership with the bank. We are an organization that they call a CDC, a Certified Development Company. There's about 260 in the nation, 14 in Pennsylvania, that we're allowed to represent. I'm not a federal employee, but we represent the SBA in this transaction. When I say private sector, think bank, loan, or other, can be truly private. Lenders in first lien position. So the bank is at a 50% loan to value. Chance of not getting 50 cents in the dollar. If the sky falls, they're probably going to get their money back. So it's a good risk position for the bank partner. The SBA takes and knows the second lien position, the risk position, takes 40% of the project. And the borrower's coming out of pocket. Instead of the traditional, if you think about a conventional loan, for real estate, let's stick with that example. 80% financing, 20% out of pocket, plus all costs. In this situation, we're trying to say less out of pocket with the potential to capitalize and add those costs to the project, which I've got a slide for. There's 2 times that this 10% can change. If the business is truly a startup, not an expansion, and if it's a special use property, special use. Think extreme examples. A car wash, I am not converting to office space without a lot of work to be done. A hotel is pretty much a hotel, no matter what you do with it. So there's extreme examples, there's fine nuances. Think professional practice, a doctor's office, and even on the line of veterinary practice. If I put too much specialty lighting in the ceiling, the tray floor, because I need it waterproof, and a lot of plumbing in the walls for my gas lines, that starts crossing that line of, is it special purpose? Is it really a hospital? Or is it a procedural room that I can wheel all of this stuff out of here and it becomes an office tomorrow? So that's the more nuance. So think hotel, car wash is the extreme example. Flex space, industrial, warehouse, not special purpose at all. And that's the line of where that goes. So I'm going to stick with the 50-40-10, and we'll kind of keep going with that example. Total project, we already talked about this, $12.5 million with the $5 million 40% fees. On the manufacturing or public policy goals, women-owned, minority-owned, veteran-owned businesses, rural development area, we can go up to 13.7, almost $13.8 million projects. So pretty sizable. We don't do too often. Admit this one. We don't do too many of that size projects. Loan terms either 10 or 20. And I think this is just a good compare-contrast to what a conventional $2 million purchase looks like. And this is scalable, obviously, but $2 million, appraisal kind of fixed no matter what size the project, and environmental. Township review, some estimated costs of what does it take to get into the project, transfer tax, $2 million project, conventional side. 80% bank financing, 20% borrower equity, and all costs out of pocket, about $452, $450. On the 504 side, I'm going to make one assumption here. The appraisal is going to support including these costs into the total project. But remember, we can go up to 90+% loan to value. So let's take that same $2 million, create a total project of 2.052. 50% bank loan, 40% SBA, out of pocket for the business owner. 450 versus 205. If I'm buying a building, because I'm sitting on each other's shoulders today because my efficiencies are all wrong as a manufacturer, stick with that idea. And I'm about to go here, and my receiving's on one side, my whole plant is on this side, my production line, and my shipping is on the other side. I'm now efficient, and I can go to a second shift and make more product, and I've got $200,000 to either buy more raw material, inventory, or hire a salesperson and grow. So I always talk about what is the less money out of pocket truly benefiting for the right people, not for everybody. A really good opportunity. 504 case study is existing wholesaler. This was pretty creative here. Basic concept is they lease the building for years. Over the past 3 years, they actually put leasehold improvements for the lease space into that, knowing that one day they may be buying it, but they just needed to make the improvements. They were looking at the building, $9.8 million, was one of our larger ones, $9.8 million purchase price, and they were saying, I can't come up with $2 million to buy this building at 20%. So they started working toward growing to $1 million. They heard about the 504. We got in here and we said, wait a second. Let's ask for a look-back period and say, you put this money into the building already for capital improvements to the building you're about to buy. Let's count that. We recognize $900,000 of the improvements that they made into it. They wrote a check for $80,000 instead of $980,000. We were friends after that. It was a good thing. So to that bar, really creative, not always the norm, but creative and flexible, but that one really worked. And again, existing wholesaler. I'm going to really go through the USDA, not to make light of it, but the USDA is shifting the federal agency over to Department of Agriculture, but don't think livestock, think B&I, business and industry. It's going to actually drive by the rural territories, not by an agricultural producer or processor. So this is the business and industry loan program. Think very, very similar to the 7A. Instead of the SBA for that guarantee, I'm going to the USDA, different federal agency. But the concept is the same with a little bit even larger dollar size. So I can go up to $10 million. If this business were to fail, I go back to the USDA and say, can I get 70% of my money back as the bank, credit union, financial institution? This is one where we're wide open. We do have a little bit of flexibility in this, and that it can talk about a nonprofit. It can talk about a developer project, non-owner occupied, and otherwise it can do a lot of the other financing. So USDA, another tool out there, not seeing a whole lot of it. The Fed actually was talking a lot about this. In the Commonwealth last year, there were over 5 of these numbers. So we're going to talk about doing more of them because it's a good program where appropriate. So overall, again, more for the handout, but I think there's a lot of conversation on these loan programs overall. Brian's about to tell you as well. What are some of the benefits, and if they fit? It's definitely worth if I have a conventional offer, even in hand, take just a quick glance at this and decide, apples to apples, does this make sense? And it's okay to walk away. So I'm not going to take up any more time. I'm going to switch over here, and obviously if there's any questions, I think during dinner, after, at lunch, or anytime, please. And I'll have cards here if anyone would like to call, if I can be a resource to any of this. But that's it.
Good morning, everybody. Brian Hansbury with Schuylkill Economic Development Corporation. As Frank had indicated, I'm going to do a little bit of a presentation about the Pennsylvania Industrial Development Authority, or PIDA as we call it. It has undergone some pretty significant changes over the last about 6 months, so I thought it was worthwhile to get in front of you all and kind of discuss some of this. So there was an act at the end of 2014, Act 161, which combined several loan programs under the PIDA umbrella. Previously, there was the PIDA program, which was strictly a real estate either acquisition or construction program. Small Business First, which was geared more towards small businesses. The Machinery and Equipment Loan Fund, which was obviously for machinery and equipment. There was also a program called the Pollution Prevention Assistance Account, which was more of an energy efficiency type program, and also a program called the Community and Economic Development Program. That's a very unique program that's geared more towards urban settings and distressed communities where, say, a community such as Hazleton doesn't have a grocery store in the downtown. That's a program that can finance that, whereas a grocery store really doesn't fit into any of the other pots of money. So what the Act did was consolidated all the programs under the PIDA umbrella, which really provided a lot more flexibility in terms of what kind of projects to get. The goal of the consolidation was really to streamline this. If somebody came to SEDCO previously and said, We want to buy a building, we need to make some improvements to it, we need to purchase some machinery and equipment, and we also need some working capital. There were 3 sets of applications, 3 loan closings, 3 sets of fees associated with that, and it really was quite cumbersome. So much so that, frankly, a lot of the programs were undersubscribed and not utilized all that much. So the State Department of Community and Economic Development pushed for several years to get this consolidation to occur, and luckily at the end of last year it did. So that's really where we are today. In terms of the eligible businesses, virtually every business is eligible for one pot of money or another. The 2 most challenging ones for us are service enterprises and hospitalities. In terms of service enterprises, we're able to do that under what was formerly the Community and Economic Development Program. Much more challenging. We really have to make a case that a community is distressed and underserved by that particular service. In terms of hospitalities, we're able to finance restaurants. However, the restaurant has to have been in existence for at least 5 years on a continuous basis. And also, as Sherwood alluded to previously, restaurants are just very difficult to finance, period, because it's such a very risky business. The 3 primary uses of these funds are, as I indicated, real estate, the machinery equipment, and working capital. The working capital is now in the form of a line of credit. We previously had working capital component of what was referred to as the Small Business First program, and I don't think they saw one deal under that jurisdiction for 5 or 6 years because it was just so difficult to get a deal done. A line of credit obviously makes a lot more sense than a simple term loan for a working capital component, so now working capital does fit into this. In terms of the real estate component, virtually every business that I mentioned previously is eligible for real estate financing through the PIDA program. One exception would be mining enterprises. Big backstory there, it's really not worth getting into. Only small businesses, however, can finance working capital and pollution prevention assistance accounts. And whereas the Small Business Administration has a very unique classification for what constitutes a small business, in general, the state uses 100 full-time jobs. And that's how they define what actually constitutes a small business for the pollution prevention assistance account and working capital. Some of the things we cannot do. Cannot refinance anything. Cannot finance something that has already commenced. So if you're doing a real estate project and you already closed on the transaction, we're not able to go in and finance those activities. There's a way to navigate through that, and we'll get to that in a moment. Also, you cannot pay owners directly for services that the owner is contributing to that business. Can't obviously finance projects in other states. Some of the very general restrictions: all your bills have to be current, all your taxes have to be current, and you can't have any conflict of interest with a certified economic development organization that's packaging a loan. Probably should have said this earlier, but all PIDA loans have to go through an organization such as SEDCO. In the Hazleton area, there's CANDO. In Berks County, there's a similar organization. Virtually every jurisdiction within the state is covered by what the state refers to as a certified economic development organization. In Schuylkill County, that is SEDCO. If the business that we're going to be lending to has some conflict of interest with the Certified Economic Development Organization, we're going to have to walk away at that point. We can put them in touch with another certified organization, whether it's NEPA Alliance, who serves a 7-county northeastern Pennsylvania jurisdiction, or somebody else. We'll be able to help them, but we might have to step in. In very general terms, PIDA can finance up to 50% of a project. However, that's usually not realistic, just because the bank is always going to be in first solely mortgage position. PIDA can go into a second mortgage position, but typically when the underwriting shakes out, if PIDA's at 50% of the total project, they're probably going to want to be in first or shared first position, and that's a deal killer for most banks. Could do up to $2 million, certainly not as large as the dollar amounts that Sherwood referred to in some of the programs he discussed. There have been discussions with the state to increase that. In some very unique situations, we could actually do $2.25 million to this project, but again, it's either going to be the $2 million or 50% of the total project cost, whichever is less. For $400,000 is the maximum borrowing for what's small businesses, those 100 full-time employees or less. So for a larger industrial type enterprise, they can borrow up to $2 million. For a small business that's fitting into certain unique classifications, they can only borrow up to $400,000. On the machinery and equipment side, total maximum borrowing amount is $400,000. Again, for service enterprises, it's limited to $200,000, but they're very difficult to finance anyway. So for machinery and equipment, $400,000 with 50% of the total project cost, again, whichever is less. Now, the working capital line of credit, this is new to when the program was revised at the end of 2014. This is a brand new component of it. I have to admit, we haven't done one of these projects through our shop yet. Hopefully we will soon. But as you can see, you're limited to, first of all, you have to be a small business to utilize this portion of the program. And you can only borrow up to $100,000. Now that, an annual term on that, so you can draw down on this line of credit up to $100,000 over a 12-month time period. But at the end of those 12 months, if you still have the need for the line of credit moving forward, you can renew that for up to 6 years. On a pollution prevention assistance account, maximum loan amount there is $100,000 or 75% of the project cost. And most of the projects that you see with that program tend to be lighting upgrades to improve energy efficiency, or in some unique situations, solar or wind installation. So really, that's the program that a lot of business used once the rate caps were expiring in the various electric utility markets. Businesses were in a hurry to try and avoid the projected large jump in energy costs. So we were able to do quite a number of deals where companies basically went in and retrofit all of their lights and went from technology that was developed 30 or 40 years ago to cutting edge, whether it be LED or compact fluorescent, really realized some significant savings that paid for the loans themselves. Now, in terms of collateral, I did mention on the real estate side that PIDA wants to be in no less than a second mortgage position. Now, with Small Business First, previously when that was a standalone program, you would see a Small Business First loan in a fourth or fifth lien position. And funny enough, a lot of those loans are now in default and frankly never going to be paid back because they were just not good deals. PIDA, on the other hand, is taking a much more conservative approach. They do not want to be exposed to that level of risk. So at a very minimum, they need to be in second lien position, but they're going to do everything that they can to be in first. On the machinery and equipment side, again, you're going to have no less than a second lien position on the equipment that you're being financed. And depending on whether or not there's a deficiency in that collateral, they may ask for additional assets to be pledged to support the loan. Working capital and the line of credit component, they're going to want a first lien position on the inventory and receivables. And again, depending on whether or not there's a deficiency, they might be able for some additional assets to be pledged. For any loan program, or for any project that we do through the PIDA program, PIDA is going to ask for a personal guarantee of any owner of the business with a 20% or greater stake. Now, the interest rates, and this is what typically sets PIDA apart from some of the other programs that Sherwood discussed. They have a pretty aggressive interest rate structure. Maybe not quite as low interest rates as we'd like to see. Every once in a while, PIDA will unveil a special interest rate. We were able to get a deal done last year at 2% fixed for 15 years, which is pretty phenomenal. But as it stands right now, there's two rate classifications that we can do on the real estate side. The first is we could fix it for up to 15 years. You're going to pay a little more on the interest rate, though. It's going to be the 10-year treasury rate plus 100 basis points. So right now, they're advertising that at 3% fixed for 15 years of the loan, which is pretty attractive. However, if you take the second option, they'll fix it for 7 years at the 10-year treasury, which right now is 2.25%. It'll then reset at the end of that 7-year period based on what the 10-year treasury is at that point. However, there will be a ceiling of 200 basis points above what you were paying previously. So it would be 4.25%. Frankly, that's going to be cheaper in every situation. So I'm not really sure who's going with this route as opposed to this route. We're not really sure why PIDA has this structure to begin with. However, when somebody comes through our door, we do let them know that there's two choices and then kind of run the numbers for them to say, well, at the end of the day, even if it resets to the ceiling, you're still going to be paying less over the life. For machinery and equipment, 3% fixed for the full term of the loan, 3% fixed for the 12-month period on the working capital piece, and then the pollution prevention assistance account is by far the lowest interest rate, 2% fixed, again for the full term. This is an important component of PIDA. Again, it is an economic development program, so they wanted to make sure that there's job creation and job retention associated with it. In general terms, it's $35,000 can be borrowed for every one job retained. $50,000 can be borrowed for every one job created. The only two that are not exposed to that requirement are service enterprises. Again, they're very difficult to finance. That's a doctor's office in the downtown urban setting that doesn't have the doctor's offices. They don't have to comply by that rule, and also agricultural producers. So agricultural producers are often, it's a mom and pop shop, and there are 3 sons who are working the farm. They're not expected to meet those job creation and retention requirements. They refer to industrial park projects and multi-tenant building projects. Organizations such as SEDCO could actually borrow through this program as well. So, clearly for a 3-man shop like SEDCO, we wouldn't be expected to create one job for $50,000 for borrowing on an industrial park project. The terms: 15 years on the real estate, 10 years or the useful life for machinery and equipment. And then again, the working capital is it's a 1-year term. However, you can renew that for up to 6 years. In terms of the application process, I'm not going to get into too much detail here. Just know that you come to an organization such as SEDCO, and we'll navigate that for you. You're not really going to have to worry about all that too much. But earlier on, I did mention that we cannot finance projects that are already underway or already completed. The one way around that is what they refer to as a non-prejudicial approval. So if you were to come through our door today and say, I really like this PIDA program, the interest rates are really attractive. However, I'm going to be closing on my building next week. Is there any way we can make something work? We will immediately then submit a request to the State Department of Community and Economic Development, say, we have a deal on the line here. They want to take advantage of the program. However, the project's ready to get underway right now. We hereby request that you grant them approval to move forward with their project at their own risk, and should the PIDA loan ultimately be approved, you could then go back and be reimbursed with the PIDA proceeds. So again, it's at your own risk, of course, but we're not going to advise you that the PIDA funds are going to be available unless we think it's a pretty strong project, adequate ability to repay, and that you fit within the eligibility requirements of it. So once we get that non-prejudicial approval in, we then begin the process of submitting the full application. It's actually on the next several pages about the application. But just in general, some of the things you're going to be looking for, we're going to need a description of the project, a description of your business, and that includes what markets you serve, major competitors that you have. We're going to need 3 years of company financial statements, if available, personal financial statement for any principal of 20% or more of ownership. For real estate, we're going to need an appraisal that's no more than a year old. We're also going to need a phase 1 environmental assessment that, again, is no more older than 1 year. We'll then take all of that accumulation, all of that information, accumulate it into one single application. So if you're doing machinery, equipment, working capital, and real estate, that's all in one application, one set of fees, one closing on the loan. We submit that then to the state and then begin the process of getting that approved. Say you wanted to gain approval at the August board meeting of the PIDA, you would have to submit by the last business day of June in order to get for the August meeting. So again, you're always going to be a month out. So the September meeting would be the last day of July, and so on and so forth. So you are going to be looking at about a 2 to 3 month period until you actually find out if your loan is going to be approved. But generally speaking, if we get to the point of actually clicking submit on the application, we're pretty confident that it would be approved. There is a board of directors for PIDA. They sit down in Harrisburg. We'll go down, meet with the board of directors at their meeting, make the case for the business to say this is why we think this loan's going to be approved. This is why it's important to our community. Field any questions that the board of directors might have, and then ultimately we would move on to closing. In terms of the closing, that's changed a little bit now. Any closing for a loan less than $400,000 will actually be prepared by the organization that submitted the application, so take SEDCO for instance, our attorney will close anything under $400,000. Anything over $400,000 will actually be closed by PIDA counsel in-house. So that's the condensed 10-minute version on the PIDA program. I think Sherwood's comment at the very beginning of his presentation was important. Communication and exposure tends to be the biggest thing. There's so many businesses throughout the area that may not even know who SEDCO is. So really the take-home message is if you're considering any kind of project, whether it's real estate, machinery, equipment, or working capital, give us a call. We'll try and point you in the right direction, whether it's PIDA or maybe it's not. Maybe it's an SBA, makes more sense, or USDA guarantee. We have other regional partners, NEPA Alliance, the Northeastern Pennsylvania Industrial Resource Center, the Manufacturers Association, even the Chamber of Commerce. There's all types of loan programs that are out there. So the take-home message is just give us a call if you're considering a project, and we'll try and link you up with the appropriate resources. I'd be happy to take any questions if you